This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to the chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at MacroVoices.com. Go to our homepage, MacroVoices.com, and click on the red button over Daniel's picture saying, looking for the downloads. All right, Eric, let's cover crude oil, starting with those EIA inventory data.
EIA printed a massive 12.5 million barrel drawdown on crude oil. But that was really a 14.1 million barrel drawdown if you also consider the additional 1.6 million barrels that was pilfered out of the Strategic Petroleum Reserve in the last week. That's right, we're still drawing down the Strategic Petroleum Reserve, now for the 8th week in a row and counting, and at an increasing rate week over week. How's that SPR refill project going, Mr. President? Cushing, Oklahoma, building 1.8 million barrels. Gasoline drawing down 2 million barrels. Distillates drawing down 562,000 barrels. U.S. production ticked back up 100,000 barrels to 12.3 million barrels. Again, 12.3 million barrels per day is the post-COVID peak production level. And it appears to be forming a plateau at that level, which I find very significant. Tape action, obviously up after inventory. That continued for a while, but as I'm speaking now, early Thursday morning before the open, well, it looks like we're drifting back down toward the 5-day moving average at 72.77. So is this really going to last? We'll see. We're still above the short-term moving averages for now, so there is hope that we're in a new uptrend, but the big test is still the continuation 100-day moving average at $76 even. As I mentioned in the feature interview, despite the flat price, backwardation indicates that we still have a very tight supply situation. So the reason the market is weak is that despite supply really and truly being in a precariously tight situation, the market just isn't sure if that supply deficiency even matters because recession signals suggest that it could be a long time before we need more supply. More recession signals could easily take prices back down to new lows. But ultimately, when we eventually need to increase supply to meet recovering demand, we won't be able to. And that's when the fireworks will start.
Yeah, Eric, on page 2, we have that chart on crude oil, and this time I put that 200-day moving average on there, but also in that green box, the range between $74 to $80 is what is the high volume node consolidation area. It's the trade range that was defined from November all the way through to March. And we really, at this stage, bounced in crude oil. And crude oil's obviously been done half decently well in the last 2-3 weeks off of a very oversold condition. But we haven't yet gotten back into that trade range. And often what was previously support acts as overhead resistance. And one of the things that we're watching here is whether or not crude oil rejects here. Like you were suggesting, there could be into a recession, another breakdown that could send crude oil right back down to the bottom end of its ranges, or like retesting even or heading down to even $60 on the short term. But you're absolutely right. At some point, there's going to be a bullish sequence that's going to come in on crude. But right now, the price action is still very negative, and there's a lot of work for the bulls to do to start to repair this chart. Nonetheless, let's move on to equities. Eric, what are you thinking here?
My formative mental picture for where the forks in the road will lie for the equity market looks like this. First, I think we're in for some volatility as the usual debt ceiling political theater leaves uncertainty in the marketplace. If we get an actual technical default on a U.S. Treasury bill, I think it could bring a dramatic correction lower across all markets, but only until they raise the debt limit and move past the debt ceiling and forget about all this. So sooner or later, they're going to raise the debt ceiling. And when they do, I expect a pop up in the markets, hopefully testing 4309, which is still my number for key resistance, the 61.8% Fibonacci retrace of the overall bear market. In my view, that's a short sell opportunity. Then, once the debt ceiling extension exuberance wears off and the market realizes that nothing's actually been solved, that would be the beginning of the next big leg down. Now, obviously, I'm lining up a lot of dominoes there, and things will change, so who knows what's actually going to happen. But for now, that's my best guess of where we're headed.
Yeah, I want to comment on your perspective there, but let's get Nick here talking about the levels. Like, what levels are you watching here, bud?
Yeah, Patrick. So right now the spot on SPX is 41.15. Expected move for the June 16th OPEX is 140 points up or down. So the lower expected move is 39.75. The upper expected move is 42.55. We have a call wall above at 4,300 and a put wall below at 3,900. And the key areas of resistance right now, just above us, are 41.50, 4,200, then 4,300. And the key areas of support, which we tested out yesterday, are 4,100, then 40.50, and then the key level of 4,000. Now, right now, I'm inclined to think we see a bit of a move higher, given that NVIDIA had a strong earning report. But I do think it's getting a bit frothy up here as well. And we'll look at the Qs in a sec. But again, I'm still very, very bullish short term, but bearish longer term, especially as we consider that we have the FOMC meeting coming up in a couple of weeks. We have talks between the White House and McConnell as well coming up, and that should cause some volatility.
Right. So on page 4, I have that S&P 500 chart. And the one thing I want to highlight is it's an interesting moment because the primary bull trend is quite intact. Even with this 2-day pullback that we had, 100 some odd S&P points, it really hasn't broken any of the primary trends. And more importantly, we have obviously tailwind like the earnings that could from NVIDIA that could create a short-term upswing in this market. But the one interesting thing is that the breadth is simply not there. The market has lost a lot of momentum outside of the NASDAQ and actually seems rather heavy for me. One of the interesting things, Nick, that I'll be watching is whether or not the excitement around NVIDIA gets faded. If we see that that kind of marks a speculative blow off on the short term, and especially if the S&P 500 doesn't make it above 4,200 during that big NASDAQ push, then to me, that would be indications that the market's path of least resistance will finally be some corrective move down. The other big thing to consider is that if there is a debt ceiling resolution, while some people may view that as short-term bullish, that is off at the table, but when the Treasury starts to refill the TGA account and drain liquidity, it might actually spur a corrective cycle in the stock market. So it's going to be a really interesting month of June, especially once we get those job numbers. Nonetheless, let's move on to page 5 where we have the NASDAQ QQQ charts. What levels are you watching here?
So spot right now is 336 approximately. We have a call wall above at 340 and a put wall below at 330. The implied move for the June 16th OPEX is plus minus 13 points. Upper expected move is 349 and the lower expected move is 323 approximately. Key resistance right now is just above at 340 and key support just below at 320. And again, with NVIDIA and their earnings report, setting the stock 30% higher, just to put it into perspective here, NVIDIA's market cap increased by more than 1.5 times the entire value of AMD overnight. So it's getting a bit frothy over here. It's very reminiscent of Tesla a couple of years back when we saw the run from, 200 to about 800 or so. And I do think there might be some more upside in the market for sure, but it's getting very frothy and the asymmetry of risk is getting very, very poor the higher we go, as we see that the NASDAQ is, at 1-year highs right now and still pushing higher. Again, you mentioned the breadth. We're seeing, a select few names rising today, for example, AMD, NVIDIA, TSM. And the interesting thing here too is that TSM's earning report is pretty drastically different than what NVIDIA stated for their guidance. So if TSM was lofty in their guidance as NVIDIA was, it would make sense to me. But it seems to me that one of them is perhaps blowing a little bit of smoke here. What are your thoughts?
Yeah, well, to me, the story is really page 6, where I have that NASDAQ 100 over the Russell 2000. And when we just see just how dramatically that NASDAQ has been outperforming over the last 3 months. I mean, overall, when you go back from the summer of last year all the way into the first early part of this year, we had the opposite scenario where the NASDAQ was actually leading on the way down and the Russell was actually holding in. And really the last 2-3 months has just seen this extraordinary divergence, and that continues to only reinforce that breadth issue that we talked about earlier. While certainly those NVIDIA bulls that, woke up this morning with a big smile on their face are certainly going to be happy, I find it really hard to see how much gas in the tank will be left to keep this trend going. Let's move on though, Nick. On page 7, we have that volatility index. And obviously we were back down to the 16, 17 range. Volatility was very low. But as this quick little correction in the last few days happened, that VIX got right back up toward the 20 level. What are you thinking here?
With the upcoming events, the FOMC and the debt ceiling talks coming up and us pushing near 20, we actually peaked above it yesterday, temporarily above 20. I think it's possible we do see a run toward 25 at some point. Again, today, that may not be the case because we're rising on the back of NVIDIA earnings, but I do see that we're going to have some volatility coming up into the June 16th OPEX, and I do foresee that we might be testing out those highs or lows, perhaps in the same time frame. So it's really important to stay on your feet here and not keep too much risk on, because again, as I mentioned prior, especially with reference to tech, the asymmetry of risk is not very good over here, right? Like you look at, for example, NVIDIA as an investment. If you were buying it right here, what's the upside perhaps, right? Is it $100 more? Is it $50 more? We don't really know, right? But the downside could be much, much higher than that versus if you bought it back in the, in the 150s back in November, December last year, right? So back to the VIX, I do think we're going to see a spike to 25 or so, probably in the next couple of weeks. And the catalyst remains to be seen, right? If they do get a deal done early on, that might give us some fuel to the upside, but it also may cause us to go down as well, right? So it's hard to really say. I'm staying kind of neutrally positioned right now, short-term bullish, longer-term bearish, and I think we're going to see some headwinds ahead, perhaps. Now, on page 8 here, we have the US dollar, which has bounced a fair bit the past couple of weeks. What are you guys thinking here?
Well, the dollar is clearly firming up here again this week, but we're still within an established consolidation range between 100 and 105 on the Dixie. My gut is that we're headed back up to retest that 105 level, and that's the moment to watch. When the Dixie hits 105, does it reject there, or does it break out and move higher? Now, that's the moment where you're not going to want to take your eye off the dollar index, but we're not there yet.
Eric, that 105 upper range is exactly what I was thinking here. And what's interesting is that the euro, to me, in this 108 to 107 level, was such a critical support area. And the euro continues to demonstrate weakness, like it's about to break through that area. If we see the euro weakening down to 106, 105, it's a given that the dollar index is going to come to that upper boundary range of that 105. But I think the bigger question is that will it stay range bound? Like, will it reject 105 and come right back to the bottom of the range? Or do, as we move into, let's say, the jobs numbers and into the summer where potentially some recessionary style numbers can emerge, will we see a risk-off cycle where the US dollar takes flow and punches even back up towards 2022 levels? And that's going to be the puzzle to solve in the coming month or two. Right now, you're absolutely right. 105 is the upper boundary. That will probably, on the first go around, cause some overhead resistance. But I think what the dollar does next is going to really be a lot about the economic cycle.
Now on page 9 here, we have the chart of the gold futures. What are you guys thinking here?
Well, for weeks and weeks, I was saying that we're right at the top of the price channel, pushing those all-time highs. And while I was still bullish that we are going to get a breakout, I thought, boy, we're overdue for a correction here, and I really hope we get one because I wanted a chance to add to my long positions at the bottom of the price channel, not at the top. Well, we finally got that correction, and we're getting very close, as you can see on the chart. We're almost down to it, having come down more than 100 points already. The 100-day moving average and the bottom of the price channel are co-located at 1939 or 1938.8 to be precise, as you can see on the chart there. So we got about 35 points to go to the downside to actually hit the line. Now, from a technical analysis standpoint, that would be your buy opportunity. But assuming that we get to that level, I'm only going to use half the dry powder that I've set aside for buying this dip in gold. I'm going to save the other half just in case we get a much deeper correction, as Tianyang warned us might be coming when we spoke about it last week. Now, as you can see on the chart, if we break down below the 100-day moving average and the bottom of the price channel, the next obvious support level is going to be the 200-day moving average down at 1840 or so. That's fully $130 more downside that's entirely plausible if that channel support breaks. So I'm holding out a little bit of extra dry powder just in case, but I do think there's an add opportunity coming up as we hit that 100-day moving average.
Eric, overall, I totally get the technical levels you're talking about. And there's certainly areas to watch. For me, though, in a much bigger picture, I'm obviously very bullish gold going into the next year or two, especially once we have some sort of a monetary easing cycle underway and potentially a US dollar weakening cycle that might come in the year or two ahead. But on the short term, if we do see broader market turbulence and a broader risk-off cycle, I could still envision gold being incredibly volatile. And while this 1930 area or so is certainly a very key level to watch at the bottom of that channel and moving averages, but a retest of those February and March lows down near 1800 is something that I wouldn't rule out. I think there's going to be some heavy swings both down and up. Overall, I think buying old dips is the right mentality, but I think it's going to be a very bumpy ride on the interim, and then we're going to have to wait deeper into the second half of the year for gold to structurally be bullish.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.